Oh, morning, everyone, and thank you for being here. Today, I'm excited to welcome you to VanEck's TruSector ETFs webinar. This presentation is titled TruSector Exposure, No Cap, some wordplay using Gen Z slang, no cap meaning no lies, and likewise, no artificial caps on exposure. Both are central to what make TruSectors unique. My name is AJ Talakdar, product analyst, and joining me today is Michael Kohik, director of product. And over the next half hour, we'll cover the problem with today's sector ETFs, how TruSector solve it, and why this adds value for asset allocators and investors alike. So here's today's roadmap. We'll begin with a quick overview of VanEck, who we are, and how our history has shaped our investment approach. Then we'll turn to the core problem, how existing sector ETFs are distorted by regulatory limits. From there, we'll go to TruSectors, explain the framework, how they solve this challenge, and walk through fun details. Finally, we'll close with some risks, next step, and Q&A for participants. If you'd like to engage, please feel free to drop a question in the Q&A box below later on in the presentation. All right, who we are. Our firm has always been about identifying influential investment themes. Founded in 1955, and since 1955, we've acted on shifts like post-World War II recovery, inflation in the 1960s, the rise of China and EM in the 90s, and the growth of ETFs in the 2000s. In 2012, we even partnered with Morningstar to launch our white mode equity strategy. And in 2017, we were the first to recognize the disruptive potential of Bitcoin and cryptocurrencies. This history matters because it shows a pattern. When markets change, VanEck adapts and often leads with solutions. Conviction over convention. All right, today we are managing over 113 billion across asset classes. That includes US and international equities, fixed income, gold and precious metals, natural resources, commodities, digital assets, and even private funds. We are offering more than 180 ETFs and ETNs globally and provide exposure across strategies ranging from active management to venture capital. This breadth of expertise provides a foundation for new innovations such as TruSectors. And this is our investment committee. Our strategies are actively monitored by a diverse investment committee. Leaders such as Jan VanEck, our CEO, John Reynolds, Greg Krenzer, David Schassler, and others oversee strategies across natural resources, emerging markets, gold, debt, multi-asset, and digital solution. And each person here has their industry experience worth decades in the industry. This team-driven oversight ensures our solutions, including TruSectors, are developed and managed with rigor and balance. And this here is our framework. Multi-layered, collaborative, and it's always working together. We employ these strategies and we make sure that they make sense from A to Z. Committees monitor these strategies, portfolio managers lead with analyst support, and our multi-asset solutions group quantitatively analyzes performance and risk. This structure ensures every strategy is designed with accountability, transparency, discipline, and overall collaboration. And this here is our approach to development, the 5 I's as we call it. Our product development framework has these 5 I's: identify, information, innovation, involvement, and insight. So we identify trends early, make sure to gather information on what is driving performance, make sure that's innovative enough to improve access for clients and investors alike, and then commit resources alongside our clients so that we're not the only ones giving you ideas, we're invested in them as well. And we continue to provide that continuous insight even after launch so that any questions, any follow-ups, any queries, we make sure that we can address them side by side. Likewise, TruSectors were developed applying this exact process, and we hope to dive deeper into this moving forward. Mike, how about we talk about TruSectors now?
Yeah, thanks, AJ. Appreciate the introduction to the firm and these new concepts that we have. So yeah, back to the title of the presentation, TruSector Exposure, No Caps. So what are we doing here? So let's kind of give a background of where the market is and why we brought these ETFs to launch. So most investors assume that the sector ETFs that they own may be giving them full sector exposure in terms of market capitalization weight. But in reality, in certain sectors, they just don't. You've heard about the run of the Mag 7. The market caps have gotten so big, the traditional indexes that a lot of ETFs track just can't provide that exposure. So why is this? It's because most of the ETFs underweight their largest companies due to regulatory caps. So these caps create a mismatch between the benchmarks that a lot of asset allocators follow and wish to align themselves with, and the actual exposures that the investors are experiencing. So we really believe TruSectors solve this problem by delivering full market cap exposure so allocators can align their portfolios with sectors more precisely. Next slide, AJ. So here's a good example. So on the right-hand side, we have a graph representing the technology sector, and on the right, consumer discretionary. So in the technology sector, companies like Microsoft, Apple, and NVIDIA, they really dominate by market cap. But existing sector ETFs just can't hold them at those weights. And this same distortion happens in consumer discretionary on the right-hand side with names like Amazon and Tesla. So investors end up underexposed to the very companies driving sector returns. So let's just look at these graphs a little more closely. So we'll just look at technology on the left. The lighter blue line represents a capped sector index in the technology sector, and the dark blue bar represents an uncapped benchmark. At the top, you can see the capped benchmark, you end up overweight smaller capitalization names, whereas at the bottom, you end up severely underweight the larger capitalization names. And the larger capitalization names are usually the stocks that are driving the sector's performance. And we started with these two sectors because this problem is most pronounced in these two. It exists in some others as well, and we're monitoring, but these are the primary culprits right now. Next slide, AJ. So let's unpack why this happens. So registered investment company rules impose diversification limits. So what are those? No more than 25% weight can be in any one single company, and no more than 50% across companies that represent a 5% weight in a portfolio or in a benchmark. So a lot of existing ETFs are tracking these capped indexes that have RIC diversification rules built into them. And of course, this makes sense for diversification. But like we said earlier, it distorts sectors where a few companies are really dominating. So in technology, again, as the example, NVIDIA and Microsoft currently exceed around 40% combined. That forces the existing ETFs to cap those exposures, even those names are driving the sector. And you can really kind of see on the right-hand side of this slide, this is a technology sector as an example. Apple, NVIDIA, and Microsoft are a huge portion of that sector. Next slide, AJ. So what is the problem that happens based on these issues? It results in performance drift. So it can be under or overperformance. So sticking with the earlier chart that we showed, the bar chart, the right-hand side is technology, the left-hand side is consumer discretionary. And these charts show that the uncapped versus capped index performance over time can deviate quite a lot. And in this example, the capped benchmarks are lagging the uncapped benchmarks. And so for investors, this really means that their ETFs may not be delivering the sector returns that they may be expecting. So just look at the bottom of these slides, and I think it really puts a point on the sentence. If we look at just the last uh, column in each of these tables, you can see the first line represents the capped sector benchmark. The second is uncapped. And the third line shows the difference. So in these examples, in this time period, you're missing out on over 6% of the return cumulatively for technology and over 4% for consumer discretionary. So that can really add up over time. Next slide. So here's a depiction of how the TruSector ETFs work and kind of like our quantitative investment process. Just going left to right, we start with the full uncapped weights of each stock. The portfolio team monitors exposures and rebalances quarterly to stay RIC compliant. So how do we do this? So we use a hybrid strategy, basically allocating directly to stocks, to equities in each sector until the limits are reached. So like we talked about earlier, that 50, 25, and then we layer in a relevant sector ETF to complete the exposure. And finally, wrap it up by providing investors a single ETF that is tradable, liquid, yet RIC compliant. So on this slide, these charts represent how the methodology really plays out. So again, left is tech, right is consumer discretionary. For TRUT, True T, our technology ETF, investors get effective exposure to Microsoft, Apple, and NVIDIA at their true market cap weights. And that's something, like we said earlier, that existing sector ETFs simply can't offer. And the same on the right-hand side applies to TRUD, or True D, our consumer discretionary ETF, with Apple and Tesla properly represented. So looking at the charts a little bit more closely, on the first line of each of these tables, you can see our portfolio weight in a relevant sector ETF. In these examples, XLK and XLY. And then down that same column, that first column, is the weight that is in our portfolio in stock. The second column represents the weight that we're getting via our exposure to the ETF that's in the portfolio. And the last column in each table represents our total exposure. And our total exposure seeks to represent the full market cap weight and therefore exposure of each stock. Next slide. The end result is elegant, in my opinion. One ticker, true market cap exposure, fully compliant. It's transparent, advisor friendly, and designed to minimize tracking error for asset allocators. And for those asset allocators, this means really simpler portfolio construction, cleaner attribution, and less noise, particularly in model construction or SMA managers. So going back to where we started, quite simply, to put it plainly, TruSectors provide true exposure without caps. They're built for allocators who need precision and efficiency. And I'll just read through our 3 key points here. TruSectors provide full market cap exposure, unlike most existing sector funds. Existing ETFs often underweight large sector weightings, causing deviation in performance. And these ETFs are really built to help asset allocators track sector benchmarks with greater precision.
And of course, when we're discussing investments, we need to consider risks. And likewise, technology, consumer discretionary are both sectors that have their own inherent risks. Technology companies face constant competitive pressure, rapid innovation cycles, regulatory scrutiny, and products can quickly become obsolete. Likewise, valuations can also swing quite wildly in the tech sector. Layered fees and investment restrictions also apply, and reliance on these software patents, which a lot of tech companies receive, can add additional risk when analyzing their portfolio. Consumer discretionary, likewise, has its own risks inherent to its sector. This sector is also highly cyclical, tied to consumer spending, global events, and quite shifting demand patterns from the consumer's behavior. Companies may be impacted by changes in labor dynamics, commodity prices, or even currency fluctuations, depending on region. And as with all funds, active management may not always deliver the intended results. So these are some risks to keep in mind. Mike, back to you.
Yes, thank you, AJ. It is very important that investors consider all risks of funds that they invest in. So we like to highlight that when we're talking through our new strategies or existing strategies. So just to wrap it up, and we're going through this quite quickly, which will give us a nice bit of time for some Q&A. So as a reminder, please feel free at the bottom of your screen to pop in some questions if you have any. Thank you for the couple that have come in. TruT, our technology TruSector ETF, it launched on August 20th of this year. It trades on NASDAQ. It carries a management fee of a low 10 basis points and a net expense ratio or a total expense ratio of 13 basis points. It pays dividends quarterly. Why is the net and gross different? That's the difference between the AFFEs or acquired fund fees and expenses, the line item you see there. And that's an indirect expense that's occurred by holding the other ETF in the portfolio. On the next slide, we'll cover TruD, our consumer discretionary fund. It also launched on the 20th, trades on NASDAQ, and has the same low management fee of only 10 basis points, and its net is 14, with a slightly higher weight in the non-VanEck ETF, and it too pays dividends quarterly. And obviously, as these funds acquire a track record, there will be performance that will be reflected on these tables. You can see most recent performance on our website as well at vaneck.com. So we have a poll that's popped up on the screen. So if you'd like to meet with somebody here at VanEck to discuss either TruSectors or any of our strategies, or just to talk about the markets, advisors can click yes in the polling question that's up on your screen right now. Or if you're not a financial advisor, just please select I'm not a financial advisor.
Great. And we are receiving quite a handful of questions here and love to walk through those with you, Mike. Maybe just sort of summarizing the first question we have here. I believe this is a good question. How does the TruSector ETFs holding an ETF help them maintain full market cap exposure while still staying compliant with RIC diversification?
Yeah, thanks, AJ. So like we said in an earlier slide where I had the example of what the exposure we're getting through holding the ETF and then holding the individual securities. So by holding an ETF in the portfolio, there are rules so long as we stay a certain percentage under that non-VanEck ETF that the IRS does not require the rule to look through to the individual holdings within the ETF. So we're constantly monitoring to make sure we remain under that percentage in order to continue to offer full market cap exposure like we are while remaining RIC compliant.
Great. Another question here coming hot. How do TruSectors simply just fit into a portfolio, maybe for an allocator or even a retail investor?
Yeah, so it's a great question. So we really think that this is part of a larger asset allocation. This shouldn't just be the only thing you're holding, because obviously you're being concentrated in some of these very large cap names in individual sectors. You could use them as a kind of replication of the overall S&P weights. I think some asset allocators do that. You could use them to express a conviction, if you would, in a certain sector as, again, part of an overall asset allocation, not as an individual holding.
Great. And quite a handful of questions regarding fees. So maybe can you talk a little bit more about like acquired fund fees and what does that imply for the investor?
Of course, yeah, that's a great question. So um, funds have direct expenses and they have indirect expenses. So direct expenses are things like the management fee, custody fees, and these typically accrue daily and are paid monthly. Um, the expenses are borne directly by the fund and they basically reduce the fund's net asset value or NAV. So that would detract from the overall total return. Indirect expenses like AFF fees, they're not accrued daily. They're not paid directly by the fund's net assets. They're reflected in the fund's pro rata share of fees and expenses incurred by the investing in the acquired funds. AFF fees are reflected in the prices of the acquired funds, so the prices that the funds are purchased at, and thus are incurred in the total return of the funds. So direct versus indirect, very important. Um, the reason why they are a line item is based on SEC regulation for fund of funds.
Got it. Got it. Thanks, Mike. Um, some more questions here. How should an investor approach concentration risks? Obviously, this is what we're trying to do with these products and diversify, but still remain within the sector. So how should investors think about concentration risks in their portfolio?
Yeah, thanks for that question. I think we kind of touched on it earlier in terms of how these fit within a portfolio. It should be, again, these should be a part of an overall asset allocation. And really, what we've discovered in client consultations is with this problem existing in the market, what a lot of investors have tried to do to get full market cap exposure to the largest names is they'll hold multiple large cap ETFs that are providing a lot of the same exposure. So not only are they concentrating in the larger names to try to get up to market cap weight, they're also getting overweight even more in the smaller capitalization names. So I think these are an elegant solution that actually help address an existing overconcentration problem that may be existing in investor portfolios. But again, I can't say it enough. This is a part of an overall asset allocation. We do not advocate that anyone just holds this as a single holding.
Right.
I see
Perhaps.
some more in the Q&A window, AJ. We have a
Yeah,
little more.
yeah, yeah. Sure. Right up front, maybe how does Rick rules even affect the regular S&P 500 index ETFs?
Yeah, so all US ETFs are subject to these risk diversification rules. I think the impact on like an S&P 500 exposure is lessened or even mitigated because purely by the number of holdings that you have, the larger weight would be not as high and therefore wouldn't breach RIC. It's when you start to break out the sectors or smaller parts of those exposures, that's where this problem really gets magnified.
Right. All right, let's say I'm an investor looking to get into the tech sector. Obviously, there's a few products out there. How would you determine which ETF to hold if there's more than one representative of the tech sector, for example?
Yeah, so the breaking out the U.S. Large cap market or any market into sectors is not a new thing. It's been done for a very long time. So we're doing it differently, obviously, which is innovative in our opinion and helping solve a real problem that exists in the market. Our portfolio managers, these are active strategies. They can choose among any existing ETFs that are out there in order to gain some of the exposure while still maintaining RIC. So it's really up to the discretion of the portfolio manager, the portfolio management team, but they have a lot to choose from. So that's a good problem to have.
Got it. And perhaps maybe you're looking forward into the future, what industries or sectors do you think would benefit from getting that full market cap exposure?
The problem exists, like I said, the two that we launched are the worst culprits right now.
Yeah.
But obviously we continue to monitor, and the problem does exist in other sectors. So, for example, communication services, there's a mismatch, and this problem occurs, I believe, to a lesser magnitude, maybe perhaps in other ones like energy. But we're monitoring all the time as part of VanEck's product development process. We like having suites of ETFs, and these really are kind of in that vein of a suite of ETFs. So, keeping our eye on it.
Great. Thanks, Mike. I believe that is it for our Q&A session. And we answered all the questions. Yeah.
Yeah.
So that's it for the TruSector's webinar. Thank you so much for joining, everybody. Please feel free to reach out if you have any further inquiries or questions. And yeah, thank you so much
Yeah.
for joining. Have a good one.